For 52 years, one network owned the bridge between every bank on Earth. SWIFT, the Society for Worldwide Interbank Financial Telecommunication. Founded in 1973, a bank in New York wants to send money to a bank in Tokyo. The message goes through SWIFT. A wire takes 1 to 5 business days. The fee is $30 to $50. SWIFT processes the message in minutes. SWIFT takes the fee out of both sides. 52 years, the same network, the same timeline, the same fee structure. Then in the fourth quarter of 2025, 4 things happened in 90 days that broke the monopoly. An executive order, a lawsuit settlement, a regulatory pivot, and a technology that had been locked out for years suddenly became essential. The question is not what replaced SWIFT. The question is whether what replaced it was always going to happen, or whether someone knew it was coming and positioned early. In November 2025, Ripple Labs released RLust, a US dollar-backed stablecoin issued on the XRP ledger. $1.3 billion in circulation. Every unit backed 1-to-1 by USD held at Gemini Trust Company. On November 6, 2025, MasterCard announced it would enable RLust payments through its network. Not theoretical, live, tested, ready, a physical credit card. Issued by MasterCard, funded by RLust. Settlement on the XRP ledger. The traditional payment flow, cardholder spends, merchants processor waits, acquiring bank waits. Settlement happens 3 to 5 days later. The RLust flow, cardholder spends, merchants processor routes it through RLust. Settlement on the XRP ledger. 3 to 5 seconds. 3 to 5 seconds instead of 3 to 5 days. That's the entire difference between the old system and the new one. Not a small optimization, a structural replacement. A wire through SWIFT takes 1 to 5 days. Cost $25 to $50 per transaction. No visibility into where the money is during settlement. A transaction through XRP ledger, 3 to 5 seconds. Cost, fractions of a cent. Full visibility in real time. Ripple's on-demand liquidity service launched in 2017. It uses XRP to bridge between currencies. 14 countries. $40 billion in cumulative transaction volume as of April 2026. In February 2026, MasterCard and Ripple announced the full operational launch of the RLust-backed MasterCard credit card through WebBank. The first time a major payment processor has made stablecoin settlement the default infrastructure instead of SWIFT. 20 trillion. That's the size of the global card payment market. If MasterCard moves even 1% of those transactions through RLust settlement, that's $200 billion flowing through the XRP ledger every year. RLust is not an accident. It is not speculation. It is Ripple positioning XRP as the settlement layer for the 21st century financial system. The bridge is not theoretical. It is live. Central banks of 57 countries are actively developing central bank digital currencies. Not hypothetical. In development or pilot testing right now. China's digital yuan has processed 3.48 billion transactions, $2.4 trillion in value transferred. But here's the moment that changed everything. On January 1st, 2026, China made the digital yuan interest-bearing. CBDC was supposed to be zero-interest government money, a replacement for physical cash. China made it yield-bearing, meaning the central bank can now control not just the money supply, but the actual return on holding that money. The ability to suppress savings, the ability to incentivize spending, the ability to apply targeted financial policy at the individual level. Russia is set to launch its digital ruble at scale on September 1st, 2026, not a pilot, a national rollout. The United States took a different path. On January 23, 2025, President Trump signed Executive Order 14,178. It explicitly prohibited any federal agency from promoting or adopting CBDC. Why? Because 2 days earlier, Congress passed the Genius Act. It created the first federal framework for private stablecoins. 100% reserve requirement. Full treasury oversight, but issued by private companies, not the government. Here is the architecture that is emerging. For retail populations, CBDC, government money, programmed, trackable for regulated commerce, stable coins, USC, RLust, 1-to-1 backed, fast, compliant. For institutional settlement, XRP, the bridge between currencies and systems. For permissionless activity, decentralized finance. Running parallel, no intermediaries. The old system, 1 meter. SWIFT, everyone funnel through us. The new system, 4 meters, 4 layers, 4 different tools for 4 different purposes. The retail population uses the innermost meter, the CBDC, and thinks that is the financial system. Institutions and regulators see the outer rings. They understand what they are. It is not a replacement of the old system. It is a stratification of it. SWIFT processed its first blockchain-based transaction in September 2025. 32 institutions participated, but competition is not the same as replacement. And SWIFT's own architecture, built on systems from the 1970s, cannot move at blockchain speed. On November 22, 2025, SWIFT legacy MT format officially retired. The new standard, ISO 20022, the global messaging language for finance, went from a proprietary SWIFT format to an open international standard. ISO 20022 is blockchain native. It can describe not just fiat currencies, but cryptocurrencies, stablecoins, and digital assets in the same messaging framework. Meanwhile, the BRICS nations are building an alternative. BRICS Pay. Capacity, 20,000 messages per second. Russia's SPFS operates across 20 countries and 556 financial institutions. China's SIPs processed $17.3 trillion in 2023, growing 30% year over year. The fragmentation is not a bug. It is the entire point. When there was one network, SWIFT, every transaction needed to go through it. When there are many networks, the transaction goes through the fastest and cheapest. SWIFT death is not a dramatic collapse. It is a slow attrition. Every percentage point that moves to BRICS Pay, to SIPs, to XRP settlement, is a percentage point SWIFT never gets back. In March 2026, the SEC and CFTC issued a joint ruling on XRP. XRP is a digital commodity, not a security, not a currency, a commodity. This closed the lawsuit that had been hanging over Ripple Labs and XRP investors for years. Goldman Sachs has accumulated $153.8 million across 4 XRP ETF products. That represents 73% of the top 30 institutional holders of XRP ETF shares. Goldman Sachs did not buy into XRP speculation. Goldman Sachs bought into infrastructure. Total assets under management in XRP ETFs as of April 2026, $1.53 billion. Compare that to the size of the market XRP is designed to serve. 20 trillion in card payments, 30 trillion in cross-border wire volume annually, 1.53 billion in XRP holdings, 30 trillion in the market to be captured. USC, Circle's stablecoin, has for the first time since 2019 overtaken UST in transaction volumes. Why? Genius Act compliance, 100% reserve, full Treasury oversight. The Clarity Act passed the House 294 to 134. It is stalled in the Senate on one issue, the yield question. If stablecoins are allowed to earn yield, they compete directly with bank deposits. The math is instructive. Allowing stablecoin yield adds approximately 0.02% to the cost of bank lending. Essentially nothing. But banks are willing to block legislation to avoid it. This is not about systemic risk. This is about market power. What you are watching is not a financial crisis. It is a financial restructuring. The question at the beginning was, what replaced SWIFT? The answer is not a single system. It is not XRP. It is not CBDC. It is not stablecoins. The answer is a stratified architecture. A system where different tools serve different purposes, where no single institution controls the entire flow, where the meter exists on 4 levels simultaneously. The settlement is not a destination. It is a restructuring. Every layer has a meter. The question is not whether the meter exists. The question is who controls each one, and whether the person who controls the innermost meter can see the outer rings, or whether they only see the layer they live in. Next episode, the war. The entities that profited from SWIFT monopoly are not surrendering that power without consequence.